Good morning, everybody. Give me a second here. I want to make sure that we're streaming properly on all of the various social media accounts, mine as well as Mr. Axel Merk's. Axel's been very happy lately because he's talking to me a lot in the last several days.
That's you're the sunshine of my day, Mike.
Yeah, I know. Many people's days, especially the trolls on X. For those that are watching this live, if any of you have any questions during this roughly hour-long conversation, whether you're watching on X, YouTube, LinkedIn, Facebook, I can see your comments. So let's make this interactive. A lot of things we're going to be talking about here post-election, a lot of interesting movement that's going on, and some perspectives here from Axel Merk. This conversation is sponsored by Axel Merk's firm, Merk Investments. They have a number of funds. Axel's obviously very well known on the gold side, but has a hell of a perspective on a lot of different parts of the marketplace, including crypto, by the way, which we'll touch on. So with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Join me for the rough hours, Mr. Axel Merk, returning champion of Merk Investments. Axel, I'm going to skip the whole tell everybody how awesome you are, and let's just get right into it. We're talking the day after the election. I thought the Trump win was priced into markets. Doesn't seem like that was really the case.
Yeah, 2 days after election. You haven't been sleeping much.
I don't even know
you
what day
haven't. You haven't
3
been
days into a fast.
sleeping much.
I have not been sleeping. That's true. Absolutely true.
Well, I suppose what hadn't been priced in is that the win was more significant. The popular vote win hadn't been priced in, for example, and also, right, the markets are a game of probability, and so when things move from a likelihood to a certainty, then obviously there's a move in the market, and yes, this shouldn't have been a surprise to anybody watching your program or anybody having a closer look. Now, the context, of course, with the caveat that almost all of us are wrong when they say what's going to happen next year. So if I put that premise up there, it's pretty clear that the incoming administration has a plan and that they're more organized than 8 years ago. Also, this is going to be a lame duck president. And I don't think Mr. Trump wants to be a lame duck president, which means I think two things. One is that he's going to try to do as much as possible in the first 100 days. And then there are lots of folks that say that he does have quote unquote coattails, and even should he at some point, or when he at some point his term is up, he'll still have significant influence. So maybe he'll be more influential than others will be. Of course, in 2 years there will be midterm elections. But for the time being, just if you want to hit on the key points, the one thing that's I think been everywhere in the news is that he wants to slash the administrative state, and that means a reduction in red tape. Obviously, usually the kind of the reality is a little less than the promise, but all else equal, that means a higher growth potential. It means higher real yield, and it means lower barriers to entry. I look at regulation as increasing barrier to entry, which is good for big business, but not so good for small business. And so one of the things that happened yesterday, for example, the Russell 2000 outperformed other markets that were also doing very well. Small cap stocks benefit from lower regulation. The other reason why Russell 2000 did well yesterday, and I'm not giving any investment recommendation here, but the other reason the Russell 2000 did well is because to the extent that a trade war might escalate because of tariffs, the Russell 2000 companies tend to be more domestically focused. So so that's just some of the things that are happening. The space that we are in, we manage about 1.6 billion in gold and gold mining. Yesterday, they had some significant headwinds, in part because of the higher real yields, and we can expand on that. I don't want to just have too much of a long monologue here. But on the tariff side, quite obviously, a lot of that has been a posturing. It's mostly a posturing tool. We'll have to see how much that means in practice. To me, tariffs mean a reduced efficiency of doing business, less efficient capital allocation, more inflationary pressures, and by the way, both of these, the less administration and higher taxes mean potentially higher nominal interest rates down the road. And then, of course, the other portion is the tax reform. A lot of promises have been made. who knows what's going to happen in practice. The one thing that's missing from the agenda, which also was missing from the Harris agenda, is entitlement reform. And so, as a gold investor, I continue to be rather concerned about the long-term viability of the dollar in the context that we're just spending. Anyway, I'll pause here.
All right, so there's a lot to unpack there. The small cap move, you can argue, was justified, so perplexing in the magnitude, purely because, yes, I agree with you. You know, less regulation should be beneficial to small caps, but I would think that would be countered by the move that we saw in yields, because there's these zombie companies, and that's been the reason why they've been held back.
Yeah, but keep in mind exactly how much they have been held back, right? The one thing we shouldn't forget is, you asked about all priced in, right? Historically there's the quote unquote selling on the news when things are expected, and that's kind of one way to look at the Russell 2000 that's been held back so much, and so finally it can have a day in the sunshine here. Obviously, we haven't had so much quote unquote selling on the news if you look at the yields overall going higher. But also, let's not keep in mind that there's a lot of noise. The other thing, by the way, that we completely missed because it's not so important, the German government collapsed yesterday. So there's a little stuff happening in Europe, in sleepy Europe.
Okay, hold on. Hold on, you got to back up there, because that sounds like a big headline. German government collapses. Let's get into that.
Oh, you missed that too. Yeah, no, it suddenly appeared in a little headline. No, as Germany or Europe has had a big mess, right? And Germany has had this coalition of the Social Democrats, the Green Party, and the pro-business Liberal Party. And the pro-business Liberal Party in history has often been kind of the balance of things, but they are European-style libertarian, if such a thing exists, and they are interested in fiscal discipline. And the counter trend, and has been an eyesore to the Social Democrats, and the other trend that's been happening for those who've actually read the small print, Mr. Draghi, many of you guys will remember him, the former head of the ECB, published this report on European competitiveness, and the headlines had indicated that, oh, we got to make things more competitive. What most people didn't cover is how he wants to do that. He wants to do that by having Europe spend 5% of EU GDP. So not just 5% increase of government spending, no, 5% of EU GDP on strategic projects to make Europe. So using government to push into different industries. And by the way, in the US, of course, we'll have that as well, more industrial activism. But massive amounts of spending on the projects where government knows exactly how to make Europe more competitive by spending money. And the Social Democrats want to do that. The Liberals push back. The issue, though, to just make it more market relevant, is the German Chancellor wants to only have elections in March, and he's getting a lot of pressure to have that earlier. We'll see how that plays along. But basically, nothing is going to happen in Germany, which is actually what else is new. Nothing has been happening in Germany.
Got a question off of X I'm going to show here. Play out the second order effects. U.S. tariffs lead to retaliation and China capital flight. What form does the flight take? How does it affect gold and crypto?
Keep that up there because there's a lot to unpack here. So, of course, to the extent that the tariffs, there is going to be a retaliation. And there's going to be a lot of retaliation in ways that you might not expect, right? I mean, the Chinese will not necessarily do a tit for tat on exactly the same thing. No, they'll do it where it hurts, where it gives the headlines. Now, the second aspect of that question is devaluation. We always like to jump to the conclusion that we like to see without there really being a connection to the premise. I don't see how that's going to happen. One of the reasons why the dollar strengthened yesterday, of course it has come down today, is because tariffs, all else equal, tend to be positive for the dollar. It's a bit more nuanced. If country like, if there were tariffs imposed against Australia, I think it would almost certainly weaken the Australian dollar. The euro, maybe a little bit. It did, of course, weaken yesterday. But the Chinese they are interested in social stability much more so than a trade war, this or that. And they see a somewhat stable currency as part of that. Trump would love to have a weaker dollar. He hasn't been very good at achieving that. And I don't think tariffs are going to be a key driver in that. The much bigger driver on the dollar is the weaponization of the dollar. I mentioned gold earlier, right? Gold historically is highly correlated to real yields. That correlation broke down when the FX reserves of Russia were seized, and that might be correlation, causation, who knows? But in any case, when you weaponize the dollar, you have an incentive for other countries to diversify. Part of the reason that's not happening overnight is because it's easier said than done. Gold is but one of the beneficiaries in that. Other central banks are not going to pile all the reserves into gold, but on the margin they'll do more. And so I do think gold is a beneficiary in that longer term process. Now that said, one of the tail risk scenarios is that of course the person who asked the question is correct, that the de-dollarization is going to accelerate rather dramatically. I cannot say that with any certainty whatsoever. One of them is because my speech is censored, and I'm not allowed, I'm a regulator, to be alarmist. It's a scenario to take into account. The more likely scenario is that it's going to be the kind of the gradual bumpy process that we've seen all along. Regarding the crypto market, I think there are bigger drivers at play right now. Obviously, the crypto space has been a very speculative place. The big change with the administration is that some order is going to come into that space. And let me first give you a little anecdote. Everybody has been watching the betting markets for the election, including these allegations of manipulation or this or that. My view on that is, by the way, that somebody who wants to come in, if the market is really mispriced, you just come in, you get a better deal. But Interactive Brokers, and then E-Trade, I believe as well, they used a platform that wasn't a crypto platform, that was regulated, and Interactive Broker actually sent out a few messages saying that because they're regulated, manipulation in our market is considered a crime. And guess what? It didn't have these spikes. And I'm not even saying that this alleged manipulation is very bad. It's just is what it is, right? If people have a lot of money and want to do it, well, go for it. It's more about disclosure about what's happening in these markets. But what's happening with this election is that this market is going to mature. It's going to mature because the US is going to be open for more crypto business. And that doesn't necessarily mean that Bitcoin is going to go through the roof, this or that. It means that there's going to be more useful applications in the digital asset space, that the technology is going to broaden, that institutions are going to be embracing it. And sure, it might mean that one or the other cryptocurrency is going to benefit from it. But it just as the betting markets, I think, that are an extremely useful application of the blockchain technology. There will be many more of these things. So sorry for pivoting here a little bit from a question about tariffs, but I don't think that there's a direct link between tariffs and the cryptocurrency going to the moon.
Do you think that Trump's going to follow through on this whole strategic Bitcoin reserve talk? Because it seems like that's what everyone's hoping for.
That's complete bullshit. Because why, right? I mean, it's a there's no need for that. Those currencies, Bitcoins are always going to be around. They might be more expensive, right? It's different from oil. You need an oil reserve, or there's an argument to be had, anyways, for an oil reserve. You don't necessarily need that for that. If you want to have a sound currency, which is it's one of the reasons why there's a gold reserve, what you need is fiscal discipline. You need fiscal sustainability. There's a lot of things that Trump has going for it in boosting business. Fiscal sustainability is not on the top of his agenda. What is on the top of his agenda, and he's made this very clear during the campaign, and I think he's very credible on that, is that he says the digital asset space is a growing industry. the US must be part of that, right? That's his argument. And so it is not right to have the regulators just shoot everything down that's being created in the US. And that is very consistent with the rest of his messaging. You do not need to have a reserve currency to achieve any of that.
I think historically it's the case that markets prefer a divided government in terms of the House and the presidency. Republicans took the sweep, right? How does that factor into the next several years here, just with a full Republican control?
Yeah, I mean, for full disclosure, I historically like gridlock because I don't like government spending too much. Although it was, I think, Rand Paul who pointed out that when you have gridlock, you have some of the biggest spending because the way you have a compromise is you promise something to everybody. So I take that, right. When you have and we don't have the exact results yet. When you have a slim majority, sometimes it's difficult to get things done because you have fringes on your party that you need to appease, and so I think we really need to see the dust settle what it exactly means. You also 60-seat majority in the Senate to get more substantial things done, but I think it's pretty clear we're not going to get an unrealized capital gains tax, and it's we'll certainly get some version of the extension of the Trump tax cuts, and so it's going to be a favorable environment, so to speak, from for the capital markets. It's also it's fairly safe to assume that the suffocating that's been happening in recent years on the administrative side is going to be reduced. It's always an illusion that when you elect somebody new, it says, "Oh, the world is going to change," right? Most of the time, you don't throw out all the regulations. Both of us, right? We are working in highly regulated spaces, and we're spending a small fortune every year on compliance. I mean, I think of ourselves as a small business. The regulator thinks of us as a big business. I mentioned earlier, right? We mentioned over 1.6 billion in assets. That may sound like a lot, but with all the margin pressure that's been around, that is actually not huge, and certainly not compared to some of the very, very big shops. But we have the same regulatory burden as the big shops have, and that is, I see it in our industry. It's very, very difficult to launch product, and what I mean with difficult, it's expensive, right? And I see that in other industries as well, and so I think a lot of that is going to change.
Was there anything particularly surprising yesterday as far as the move goes? I mean, the entire market ran, gold sold off. Not yesterday, again, 2 days ago. Again, I don't know what day it is. But was there anything that, like, to you, just observing the reaction, was there anything that just seemed like really odd?
I would have been surprised if there had not been something really odd, right? I mean, you have all this tension building up, then you have an event, and then things are going to go out. Now, what was surprising is the results were trickling in. The markets had made up their mind, and you saw the major networks still noodling around on the details, on talking about different districts and this and that. And so, the markets are pretty good at absorbing information. Um, but again, right, as the dust is settling, we will know more, and we'll know how things unfold. I was looking here at my screen, right? We're talking here on Thursday morning, and the Norwegian crown is up 2% this morning, and so it's yesterday the currencies were down sharply, right? The euro was very weak yesterday. It's recovering a little bit today. Um, Ultimately, right, we always make a huge deal about elections, and of course they're emotional, and of course there will be substantive change. But ultimately, when you hear an outgoing president, most of them say yes, they've changed things at the margin, but they weren't able to change things radically and completely. And then so there's always the hope for significant change, and then the realities of the bureaucratic processes kicks in. And and it doesn't mean I don't think that the Trump presidency can't have a profound impact, but as far as the markets are concerned, there will be always a little bit of a back and forth. And so, just to answer your question regarding the price of gold, what has been astounding is how much a rally gold had without really any very significant correction. And given that as we're talking here, we are just at around $2,700 an ounce in the spot market. A $50 move per troy ounce isn't as much as it used to be when we were at 1,700. And so on a percentage basis, of course, we had a pronounced move yesterday, but it's in many ways, it's part of the noise that you would expect. When it comes to the gold miners, by the way, the financing conditions are far more important than the price level. None of these gold miners are planning for $2,700 an ounce. They wouldn't get any money because there's no assurance. As a gold investor, we may think the price is going to be there, but as an operator and somebody who's developing a mine, you cannot count on that. And so most developers and investors in the mining space, they're expecting them to get their house in order at a far more modest price. And so we also we look for company-specific catalysts. We're looking for the right management teams. We're not saying, hey, we can only invest in this gold mine if the price of gold is at $2,700 an ounce, it's going to go up to the roof. And so it's these market moves, of course, are relevant. But as a long-term investor, you've got to focus on the fundamentals and the bigger picture.
There's a lot of volatility on the currency side, obviously. How does current volatility impact gold mining stocks, many of which are, sure, they're in Canada, but they're also in all kinds of other markets? I mean, it's not really, I think, about the price movement. It's about the uncertainty about where the price is going to land.
Well, some of the big input costs are energy is a big input cost, right? When you mine gold, but the other big portion is labor. If you are in Australia and the Australian dollar weakens, the cost of labor relative to the price of gold is going down, and so having a weaker local currency as a gold miner can be beneficial to your margins. And there's been, of course, a lot in the news about that the mining companies haven't been able to manage their costs during the pandemic, during the previous cycle, right? They weren't very focused on cost. This time around, they tried to, but in the pandemic, everything was more expensive. Then we had Newmont Mining, and I'm not giving any investment recommendation here on any specific company I might mention, had disappointing earnings, complaining about costs. We think that's somewhat company specific because we haven't seen much of that in other companies. For the most part, and they're having some merger issues on top of that that they have to deal with. For the most part, the cost issues in this industry are somewhat in the rearview mirror, and we see significant margin expansion. At the same time, of course, a lot of that isn't priced into many of the securities.
Do you think our industry is going to thrive? And what I mean by that is, let's face it, the last several years have been unusual in that it's largely been dominated by just large cap momentum, passive. Everybody just wants, Vanguard type products. Do you think under a Trump administration, just market dynamics in general will change, that there's a shift towards things which have lagged because of the changes he could bring in?
I see how you use the word lagged, having the lead lag report. So I noticed that.
My brain is clearly lagging, given, as far as the election timeline. Yeah.
Well, let me first give a selfish pitch, I suppose. In the mining space, more so than any other, I believe there's a strong case to be made for active management. The ETFs, they cannot help fund mining companies as we do. We help institutionalize many companies. The problem in mining is that your assets deplete rather rapidly. You tend to have only several years of mine life. Now, obviously, once you start getting the gold out, you start trying to find gold nearby. But the rest of it, you need to do with joint ventures, through acquisitions, or whatever it is. And the big companies are so large that they're large at copper gold deposits that tend to be a little larger. And on the active management side, we have shown that we can generate alpha, significant alpha, by going there. And That is in vogue, I suppose, when the space overall is in vogue. It was not a popular space to be in the higher for longer environment. In the higher for longer environment, you have tight financing conditions, tight credit conditions, and these junior mining companies need to have access to credit. Now, to answer your question more broadly, when you have zero interest rates, why on earth should you do active management? Because everything goes up. I mean, that's also why there was the growth of all your social investment. You don't care whether your company makes money. You like green investing. You put some money into green. It's going to go up anyway. Now, I'm being a bit sarcastic here, as you might gauge. Right, I'm not recommending that you actually do that, but that's the attitude of many investors. And so the time active management tends to thrive is when the stock market more broadly does perform poorly. Obviously, as we're speaking today, the market is up as of right now. Yesterday, it was up quite a bit. Um, the other driver, though, that's going people to do market management if they're concerned about valuations. And I'm using Max 7 here as a proxy. It's obviously not just the Max 7, but when the leadership is concentrated, people are looking increasingly for diversification. But I mentioned the Russell 2000 earlier, right? The Russell 2000 lagged for an extended period. And so you have a lot of people who threw in the towel and said, hey, what the hell do I care about that? I'm going to be with the S&P 500 because that's the only place to be. It's when people need to have more choices available, or feel the need to have more choices available. I happen to think in a somewhat more normal interest rate environment, which we are in right now, active management is valuable, and not just valuable, is of more interest to investors. So I think it's really the ZERP environment that's been a killer for active management. Rebuilding that is difficult because a lot of talent has left the industry.
Which in theory should mean the active opportunities are even larger, right? Because there's less money chasing those anomalies, right? And those opportunities. It's just
looking at our space, there are very few people do what we do. And it provides opportunity for us when we have a lot of influence on deal structures when there's money raised in the mining industry, because there aren't that many around. Now, obviously, you want some around because you want other strong hands to be there when the next time comes up when these companies need funding. A lot of space has moved to the private side, right? I mean, we do some quasi venture capital investment in our closed-end fund. And so on the private side, there are a lot of sophisticated providers of capital. When you asked about kind of what's going to change with this administration, we need to make it easier again for companies to go public. Companies that go public hire a lot more people, and having so much red tape there and having it so unattractive to go public is not good for an economy overall.
We also have this little organization called the Fed, apparently coming up with a decision to do something on rates. The Fed typically follows the bond market, which I think means the Fed should probably raise rates post-election. But I want to get your thoughts on what you think the Fed's going to do here, because I think things got a lot more complicated for them.
Well, first, we're talking a few hours before the Fed comes out. When I drink this, some people have said this is beer, and I'm getting the drink here before. No, this is iced tea. I'm addicted to iced tea, and I'm having my iced tea in the morning.
But is it spiked iced tea, is the question. It could be. I mean, nobody's going to know. I mean,
nobody's going to know. No. So the Fed has made it very clear that they are looking not at what might happen, but what is happening or has happened. And they've said that over and over again, which means that their hands are somewhat tied. And although the markets are clearly indicating to us that the situation has changed, just because the S&P moves somewhere or the bond market moves somewhere, unless there is a systemic risk, the Fed's hands are tied. And because they haven't communicated anything else in their framework, they just cannot say, hey, a rate cut isn't necessary anymore today because of everything that we expect to happen in the Trump administration. And so they are hostages of their framework. And I've been on your program, I've said it in other venues, I am very, very critical of their framework. because I don't think they have a proper framework. They would. What you really want to have is a rules-based approach, where you don't have a debating committee decide on these rates that's almost by definition going to be late with whatever that they're going to do, and have their cognitive biases of the predictions that they have given and whatnot, so that when the situation on the ground does change, they can act. But we have a Fed chair that is more concerned about the economy than inflation. He is given, I say he's given his mission accomplished speech last October a year ago. Many people put it in December. The reason I put it in October is because if you listen carefully to what he said, he kind of said, oh yeah, we don't need to have so much more higher for longer rates. And that was exactly, by the way, when the junior mining companies started to show some sign of life, and not just in that space. That's just the space we watch most closely, maybe. And so he wants to lower rates, and so that's one of the context. And as we're speaking, right, it's yesterday the price of gold was down, and we're up $40 an ounce as we talk. Who knows how it's going to close, and by the time somebody's watching the replay. But it is one of these things, right, where we say, oh my God, everything is going to change when we have a new administration. And then people wake up today and says, oh, I forgot, we have a Fed meeting. Oh, and by the way, the Fed is going to be dovish. And yes, he's going to get questions about the new administration, and guess what? He's going to punt those questions, and then maybe he's going to misspeak, and the market is going to take it on, and then 2 or 3 days later, things are going to go back to somewhat more normal. By the way, as we speak, the real yields, the longer term real yields, had spiked yesterday to about 210, and they're back at 201 as I look at it. And if I can just continue with my rant here for a moment. Many people saying, what the hell do you care about longer term real yields? Nobody knows what inflation is going to be in the long run. Nobody knows what the real yields are going to be in the long run. That's all correct. But but there is a way that you can see the pricing of these things, and you can see relative changes. Relative changes matter, because treasuries are the ultimate anchor of the quote unquote risk-free asset, risk-free by regulation, not by purchasing power. And to me, they are a confidence indicator in the Fed most notably, but of course, other things like the growth potential of an economy and so forth are also priced into that.
I wonder what sectors of the market are probably going to benefit the most. So typically, when you have a Republican in office, it is the commodity space, it's the energy space, it's the material space that tends to do better, and tech tends to be weaker. How much of the active discussion is going to be a function of just tech underperformance, which will then force underperformance of passive vehicles?
So you're asking me the crystal ball question, end of the year outlook for the next year, which means everything I tell you will almost certainly be wrong. And the way I like to approach a question like that when I get it is, I don't see my role in procrastinating and telling you what will happen next year. I think the role that I have, and others you talk to probably as well, is getting you out of your comfort zone, thinking about risks you may not have considered in your portfolio. And if you think that risk is serious enough, what do you do about it? And can you afford that risk? And obviously, whatever you do about it, you also got to afford that risk. And so in that sense, we've had, of course, this massive run up in the Max 7, and the Oracle of Omaha, right, the Berkshire Hathaway, has been accumulating cash and cash and cash up to the point they get ridiculed. And then at the end of the day, they're proven right. The only caveat is, I don't think Warren Buffett could call them the shots there anymore. But the philosophy has kind of survived to be very value oriented, and so they're reducing stakes in large cap tech companies. I don't want to mention Apple here by name because I don't want to give a market forecast. But there is a sense that those market leaders may not be the market leaders. And I alluded to the Russell 2000 now. The Russell 2000, the small cap value, when you look at after the .com bust, right? It was small cap value in particular that performed extraordinarily well. What plays against it is that we've had the most forecast recession ever that may not have happened. By the way, part of the reason why it may not have happened is because the Fed is ever doing more micromanagement of the economy, makes it more difficult to use your old charts to predict things. When you give a lifeline to the banking system, converting an acute problem into a chronic problem, and I know I think you tweeted earlier today that, oh my God, the rise in bond yields, where's going to be the blow up in the banking system, right? The Federal Reserve has 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 kind of taken care, has given so many Fed puts that you may see a recession here and there in a segment of the economy, but not necessarily in the broader economy. You might see headwinds and recession based on tariffs. By the way, one reason I don't like tariffs is because it deepens the swamp. Everybody's going to ask for an exception. And so favoritism is the name of the game. It's part of the inefficient capital allocation. And so there you'll see some things. I'm in, I mean, I have a full disclosure, right? Again, we manage gold and gold mining. I happen to think that that's the time you don't want to be in gold and gold mining. If you look at the past 20 years, and that's no guarantee of how it's going to go in the future, is in a financial repression scenario where you have very high inflation and super low interest rates. That environment hasn't been good, and in part because the markets are forward looking and they think that something is going to happen at some point. There are other things to be in more. So I am very happily positioned here, in part because of that de-dollarization risk. So I happen to take that more seriously. I have personally diversified to things beyond the stock market, into everything from agriculture, notably as well, forestry and other things. I have bought more real estate in some places, thinking the prices are down. Do I know whether that's going to do great? I don't, but I am concerned about the valuations we have in kind of the classic markets, and I can afford to diversify, and I'm taking advantage of that with a particular emphasis on the gold and gold mining space, in part because I think it's going to do well, but the other part is, of course, because it's the space that I know very well. And so anybody else listening, I'm not saying you have to invest in what I have to invest in. You might want to invest in the stuff that you know very well, which, by the way, includes investing in yourself, because that's the one thing you can control the best.
Have you found that investor sentiment towards gold and gold miners has become more favorable? Are you seeing more institutional flows on the Merk investment side? Because I think from what I've seen, at least it looks like, for example, a lot of the ETFs on the gold side haven't really gotten net assets. So gold price has been running, but you're not seeing, the kind of more asset allocation participation like you would otherwise think, given how strong the trend has been.
Yeah, so we have one open-end product and an exchange-traded product, and then we have a closed-end product where we don't actually have new shares that are being created. And I don't want to mention the names here. Please come to merkinvestments.com to learn more about them. But it's just gets too hairy with regulations if I discuss the products here in detail. But we've actually had, on a percentage basis, I think the best inflows in our segment, in our gold product, and had steady inflows. So there is clearly a pickup. Now, the industry as a whole has had mixed results in that particular segment. But overall, the volume has certainly picked up and been of interest. In our gold mining product, that's the closed-end fund, we have seen that the summer was a bit of a lull, that's very seasonal. But we've certainly had many more conversations with people who want to learn about that space. And that space is, in our view at least, even though it's done phenomenally well this year, continues to be somewhat depressed. And there are many reasons. We had a webinar, we have a replay available on our website, going into that a little bit. But there is increased interest. What we don't have is euphoria. We don't have the typical signs of a market peak, and so that's quite encouraging to us.
Yeah, that's why. I mean, again, as we're speaking, gold is having a decent sized recovery, but I I don't know. I don't think that the gold reaction is anything other than either noise, to your point about what you mentioned earlier, or potentially one of those buy the dip type of moments. I saw somebody say that it's not just about real yields; it's also about war concerns when it comes to gold. And the bet would be, well, if Trump can somehow end wars and all this stuff, and that's why gold would be weak. I wonder how much you think about geopolitical risk getting priced in and how Trump could affect that.
So historically, and I say historically because my view has evolved since then. Historically, I've brushed geopolitical risk on the gold side aside a little bit. There's gold mining is of course a little different because you have real headwinds, and that's just comes with the territory. The U.S., by the way, has geopolitical risk as well in gold mining, on permitting and whatnot, and so that's always been there. But regarding the price of gold, the reason I've historically shrugged it off somewhat is because the market gets used to a crisis. Let there be a terrorist attack, the price of gold goes up, and sure enough, that bump up gets reversed within a short order. And even though there might be more terrorist attacks coming, what has changed, and I think that has structurally changed, is that we have left the relatively peaceful period we had since World War II in the rearview mirror. I consider the conflicts we have, be that in Gaza or Ukraine, or the rising tensions in the South China Sea there, as symptoms of a new era where the U.S. is no longer able and or willing to keep kind of global peace in order, where there is a rise of populist sentiment throughout the world, where countries that have less stable institutions than the U.S. are at risk of collapse, or other local conflict, where old powers might reassert themselves for various reasons. And what all of that means is that the premium that in gold might be there for an extended period, in part because, again, if you just get it down to business, it increases the cost of doing business. It is somewhat inflationary when you have to get your production more locally because you cannot import as much because you don't know whether you can get things over through international waters safely and so forth. That increases the cost of doing business, and net that is a benefit to gold, to the price of gold. I always correct myself from gold to the price of gold because I like to remind people that gold does not change. It's the price of gold that changes.
Yes, but also FOMO changes, right, as the longer trend persists. Going back to crypto did well, gold did not. The two can obviously perform well together. Do you view gold and crypto as good diversifiers for the next 4 years against equities?
So let me maybe give you a long answer here, to give you a little context of the perspective that I'm coming from. I'm obviously, right, we are focused on gold and gold mining, but we've been approached on crypto things many times over. And many of your viewers, and you might not even be aware, is I studied public key cryptography in the 1980s. And so I've actually had some views as all this has matured. I know some of the key players that were involved in that at the time.
Are you going to tell me that you're Satoshi? Is that the big reveal? Is
That's
that what this is leading up to? I'm asking. Because that would be like, then this podcast is really going to blow up.
The other thing, just somewhat related, is many people are not aware, I have a master's in computer science with a focus on artificial intelligence. Indeed, one of the books I read in the 80s, Judea Pearl wrote it on AI. I picked up a book a few years ago, The Book of Why. It's a very technical book, a very academic book. So I love the book, but you got to be a little technical minded to read it. And it says, I know this guy. And it talks about how AI in particular, just like statistics, does a lot about correlation, but not so much about causation. That in the scientific community, causation is really not well understood. We don't even have a proper language for it. anyways, all of that means is have opinions about a lot of what's happening in the crypto space, a lot about what's happening in the AI space, and I've always seen kind of the rise of Bitcoin as a phenomenon for all the reasons that, of course, everybody knows, that the dissatisfaction about what's in the and diversification that people need, the and gold. The advantage gold has over crypto is that it's not traceable. So it's if you just hold your bar, whereas crypto is actually very traceable. The reason why it hasn't made it to the mainstream, to the regulatory environment, is ironically is AML concerns, anti-money laundering concerns, that it's allegedly not traceable. Of course, it is super traceable, right? But you can get things in that where the government doesn't have the pulse on it, and they think that they can control it. If you look at how Bitcoin is trading, it is trading a lot based on events that are crypto specific, like the rise in Bitcoin based on the election. It is not very well correlated to the price of gold. It is trading at times more like a risk assets. So I think Bitcoin still wants to decide what it wants to be when it grows up. And so I've been reluctant to kind of put it, and at the same time, right, with it being available on an exchange, through an exchange traded product, it allows institutions that must use more traditional means of accessing it to participate. And so all of that, what I mean to say with all that, this is all part of the growing up of that space. I am personally far more interested with everything else that you can do with the digital asset technology than any one asset, notably let that be Bitcoin. And so I'm, in that sense, I'm just a simpleton, and like gold. And the reason I say that, because gold just is, it's just so much easier. People ask me about silver, right? In silver, you have many other dynamics already going on because you have all the industrial use as well. I'm not sure whether I'm answering your question, but that is my answer.
I'm gonna use that line. I'm not sure I'm answering the question, but that's my answer. So one of the things that's interesting about doing these kind of podcasts and conversations, not just when I do them, but others on the investing side, is it's always about macro largely and individual ideas every now and then. But rarely do people actually get to know the person that is talking about these ideas. So I'm going to ask you, just out of curiosity, aside from the fact that you may be Satoshi, any other maybe 2 or 3 kind of random, fun, interesting things about you, separate from gold? I mean, let's get a little bit deeper in terms of who Axel Merk is.
Yeah. Well, I mean, I alluded to one of those, right? That as people can tell from my accent, I was born in Munich to a beer family, and not that my parents were involved in it, but large pool of relatives. So I come from a brewing tradition, genetically anyway. And indeed, I was a foreign kid at a college on the East Coast, and I was taught by a Polish guy about public key cryptography. Mind you, that was technically illegal at the time because it was still public key cryptography was still government regulated, and so that was interesting. I've always been a do-it-yourself person. One thing people don't know about myself: I never really worked for anybody else other than summer jobs, and so I was a startup guy before that name was coined. I started the Merck Investments in 1994, so we have our 30th anniversary this year. We became a real business in 2005. What I mean with that is that we had our first public product, and rather than being more like a mom and pop type of shop. On the personal side, I have numerous interests that are a bit of more specialized. I just spent a week in Finland working in the forest. I bought we as a family outside of American Investments several hundred acres of forest, and that and when I do things, I like to roll up my sleeves. We have a vineyard here in California where I fix the irrigation and do other things. And then one thing people don't know about me, and usually people that do this say that in the first time they meet. I'm a private pilot, and I've been flying since 1997. And during the pandemic, I added a helicopter rating. The reason I did that is I cut out the middleman, as I call it. Airports got more complicated. You couldn't get a courtesy car because you couldn't touch the wheels. They could be contagious. I said, well, let's skip the airport altogether. So I've had some, I do things. I'm a person of action. When I see something, I try to fix it, be that with investment products. One of the products we have, by the way, it took us 3 years to develop, over $1 million to develop. I like to get my hands dirty and do things right. By the way, one way to think about who I am, I'm married to an engineer. I'm a computer scientist. The difference between an engineer and a computer scientist is engineer just gets stuff done. A computer scientist will generalize the solution to a problem, even if the sample size is one.
That sounds like Wall Street, my friend. For those that are watching, Axel, who want to sign up to your newsletter and follow you, where would you point them to?
Well, merkinvestments.com is our website. From there, you can see what we do. Sign up for our newsletter. We have a little survey there that you can do on Twitter. And there's a replay link also to a webinar we held on gold miners. I encourage anybody who's interested in that space to watch that. On Twitter, at Axel Merk is my handle. That's really where I can give a up to the minute, often comment on the markets, with the warning that when the Fed or ECB meets, I can get very active. I do tease Michael on Twitter as well. So for that alone, it's worth to join me.
all the time. By the way, you know that picture that you responded to that I said, before and after, I had the face picture, and that was actually the picture. Well, but that was actually that. Well, no, there was another one, but that picture one of the pictures I sent was the picture of you and me in Maine. And
that's right. We met in person, and I wasn't sure. Then I saw you a little later on social media. So is that the person that I met? No, you're looking good. You're looking good. I'm doing more exercise as well. I'm not doing your crazy fasting stuff, but I do try to stay in shape. Yes.
Well, I mean, listen, you can afford a helicopter to escape the zombie apocalypse. I have to run. So that's appreciate everybody that watched here. This will be an edited podcast under Lead Lag Live. Please stay tuned for that. Again, this conversation was sponsored by Merk Investments. Check out Merk Investments website. Make sure you follow Axel, and we'll see you on the next episode. Thanks, Axel. Appreciate it.
Have a great one.
Cheers, everybody.